Central bank officials defending last week's half-point cut as necessary to sustain balance in the U.S. economy. Investors now turning their attention towards a slew of economic prints in the weeks ahead that could provide a look inside at the health of the labor market, also maybe some clues on what the Fed is going to do next. Joining us now, we want to bring in Stephanie Roth. She is Wolfe Research chief economist. Stephanie, it's great to have you back here on Yahoo Finance. Let's talk about the 50 basis point cut. I think a lot of people are looking at this, trying to figure out whether or not this was a preemptive move, whether or not we should be worried about some of that softening within the labor market. What do you think?
I mean, it was probably preemptive to some extent. At the same time, the Fed has a lot of room, right? Rates at 550 with policy estimates somewhere around at least 4%, maybe even lower for neutral. They have a lot of room to go big at the beginning. And also, Powell didn't fully acknowledge this. He kind of danced around the question, but they asked whether we were just catching up from the July cut that probably they should have done. And he didn't exactly say this was the case, but I think you could read from the body language that wasn't what he was implying, that they should have cut in July. They didn't. Now they did the 50 basis point cut. And from here, it's going to depend on the labor market and inflation. And inflation is trending back down towards that 2%. So it makes sense for them to be getting back down towards a policy rate that's closer to neutral.
You know, Stephanie, it's so interesting because as we're seeing right now, Bowman coming out saying that core inflation remains, quote, uncomfortably above that 2% target, seeing greater risk to inflation than the labor market. It doesn't sound like you necessarily agree with that sentiment.
No, I don't. And if you listen to Waller from Friday, he said kind of the opposite. He said he's worried about inflation perhaps missing to the downside. And the more recent run rate in core PCE is running below 2%. So if you look at core PCE, which is in fact their target, and if you don't look at a year-over-year basis, because year-over-year inflation is a little bit lagged to some extent, that's 2.6. But if you look at a 3 and 6 month change in core PCE, you're running below 2%. So they're now, especially with labor market starting to sort of decelerate meaningfully, they're at risk of potentially missing to the downside. And the SEP, or the Summary of Economic Projections, which they put out last week, indicated that risks are now more balanced on the inflation side and skewed to unemployment rate rising from here.
It seems, though, from Bowman, that there are greater risks to inflation than the labor market. Where are some of those risks? Are we just thinking about exogenous threats that we can't anticipate, or is there something more broadly that they see brewing right now?
Well, she might be concerned that wage inflation is still running a little bit high because wage inflation feeds most closely into service inflation, which is the biggest part of the inflation basket. But if you look at the more recent trend that you've seen a deceleration in employment growth, then you should expect wage growth to follow as well. You could be talking about some of the one-off factors. So, Boeing strikers potentially getting a boost to their wage inflation, or port strikes potentially disrupting activity. But those things should be temporary, and the Fed should generally look through that. And at this point, the risk of having a labor market that weakens more materially is more significant for the economy than having inflation run a bit high. We've been in an environment where inflation was a little bit elevated, and we kind of were able to pull through that. But if we start to see the labor market really, really melt down, that could be a recession risk, and the Fed wants to avoid that.
So, Stephanie, what's the most important data point, do you think, decide between 25 and 50 basis points? I'm assuming it's the labor market here from your commentary. And then I guess if that is true, and to go a step further, then what is that threshold that you think the Fed is closely watching to decide how concerned they're going to be about the health and the strength of the labor market?
So it's certainly going to be the payrolls print next Friday. So we have a week and a half to sort of think about the estimates there. But our base case is that we're going to see payrolls come in a little bit better than the market is fearing. So the threshold that you were referring to, I would say somewhere between 120 and 130,000 on payrolls. So if we get something that's notably lower than that, that might push the Fed to be more likely to do a 50 basis point cut. If we get something that's closer to that threshold or above, then the Fed might feel a little bit more comfortable just going 20 basis points from here. Similarly, the unemployment rate. If it rises certainly to 4.3, that would be some reason to do a 50. If it rises towards 4.4, then a 50 is almost certain. So it kind of is going to depend on the nuances within that print, but hands down, the payrolls print is going to be arguably the most important thing determining the next couple of moves from the Fed.
At this juncture, is it too early to get a sense of what a terminal rate could look like at the end of this cutting cycle?
I mean, the Fed is telling us it's close to that 2.8. We think it should be somewhere around there as well. Where our base case is that they'll cut at least to 3%. perhaps even by the end of 2025. So now that they're potentially accelerating this cutting cycle, we could easily see 3% in the not so distant future, and then maybe just a couple of cuts after that.
Stephanie, I wanted to take a look at what's happening around the globe and specifically China. The stimulus measures that were announced this morning, obviously they're doing it in an effort to boost their struggling economy. But I'm curious what you see as the ripple effects on a global scale.
I mean, we've heard this so many times before that China's going to be easing, and there's excitement about the impact on the global economy, and it hasn't played out. So we remain fairly skeptical that any easing moves that they do out of China will be large enough such that it will have a global implication, boosting the global economy. Base case is it perhaps helps to stabilize their economy at the margin, helps to stabilize confidence, but that's kind of it. They're still trying to deal with the bubbles that they have, especially on the housing side, and they don't want to really accelerate their economy meaningfully. So it's likely to be fairly modest, and base case, it doesn't have this global implication, especially from an inflation perspective.